Let's talk about making money. When you think about investing, what's the first thing that pops into your head? For most people, it's probably the stock market. You might picture the chaotic floor of the New York Stock Exchange, with traders yelling and numbers flashing across screens. Or maybe you think about cryptocurrency, the wild west of the digital age, with stories of people becoming millionaires overnight and losing it all just as fast. Perhaps real estate is your go-to, imagining flipping houses or collecting rent from a portfolio of downtown condos. These are the usual suspects. But what if I told you there's another asset class, quietly outperforming many flashy alternatives for decades? It's an asset as old as civilization, often overlooked by the average investor. I'm talking about farmland, the very ground that grows our food. It might not sound as exciting as a hot tech stock or a new cryptocurrency, but the returns can be just as impressive, and with a fraction of the volatility. Farmland is the bedrock of our global food supply. Its value tied to one of the most fundamental human needs: eating. This isn't about a speculative trend or a digital fad. It's about a tangible, essential resource that sustains a growing population. A real physical asset you can see and touch, providing security you don't get from a line of code or a stock certificate. You might be thinking, that sounds great, but I'm not a farmer. I live in the city. The closest I get to agriculture is the produce aisle. That's the beauty of today's investing landscape. In the past, owning productive farmland was reserved for a select few. Either you inherited it, or you had massive capital, and the specialized knowledge to buy and manage a farm. The barrier to entry was immense. An average 9-to-5 worker buying a cornfield seemed about as likely as buying a private jet. But investing has changed dramatically. Financial innovation and new technology are crumbling those barriers. You no longer need millions of dollars, a degree in agronomy, or even a pair of work boots to get in. Today, there are multiple pathways to invest in farmland, as accessible as buying a share of Apple or investing in an S&P 500 index fund. This video is your guide, how you, with no prior experience, can tap into this underrated investment and potentially generate long-term returns. We'll break it down, step by step, so you can see if this asset fits your portfolio. So, what's the big deal? Why is an asset that's been around for millennia suddenly catching the eye? Sophisticated investors and financial institutions? The secret is out. Farmland has a track record of performance that is simply too good to ignore. Over the past several decades, U.S. farmland has consistently delivered strong, stable returns, rivaled and often surpassed those of the stock market. And it's done so with significantly less drama and volatility. While the stock market can feel like a roller coaster, with gut-wrenching drops and euphoric highs, farmland values tend to appreciate in a slow, steady, and predictable upward climb. This stability is a huge draw in a world filled with economic uncertainty. One of the most powerful features of farmland as an investment is its role as a hedge against inflation. Think about it. When the price of goods and services goes up, that's inflation. The price of food goes up with it. Since farmland is what produces that food, the value of the land and the income it generates tend to rise during inflationary periods. This makes it a fantastic way to protect the purchasing power of your money. While cash sitting in a savings account is losing value to inflation every single day, an investment in productive land is actually benefiting from it. This intrinsic link to the cost of living provides a layer of defense for your portfolio that few other assets can offer, making it a smart strategic move for long-term wealth preservation. Furthermore, the fundamental principles of supply and demand are overwhelmingly in favor of farmland. The world's population is projected to approach 10 billion people by 2050. That's billions of new mouths to feed, all requiring calories that must be grown on a finite amount of arable land. In fact, the amount of available farmland per person is steadily decreasing due to urbanization, soil degradation, and climate change. This simple, powerful dynamic, increasing demand for food and a shrinking supply of the land needed to grow it, creates immense upward pressure on farmland values. You don't need to be an economist to understand that when demand for something essential outstrips its supply, its price is likely to go up. This is the core thesis driving institutional money into the sector. This combination of historical outperformance, inflation protection, and powerful long-term demand trends is why farmland is no longer just for farmers. Big-name investors, and even pension funds, are allocating significant portions of their portfolios to agricultural land. They see it as a stable, non-correlated asset that can anchor a portfolio and deliver reliable returns, regardless of what's happening in the stock markets or bond markets. They understand that investing in the source of our global food supply is one of the most secure long-term bets you can make. And now, for the first time in history, you have the opportunity to invest right alongside them using the very same logic to build your own wealth. Okay, so you're sold on the why. Farmland is a solid inflation-busting asset with a bright future. But the how might still seem a bit fuzzy. The good news is that we're going to clear that up right now. The most important thing to understand is that there are broadly two ways to get exposure to this asset class: direct ownership and indirect ownership. Direct ownership is the traditional route. This involves you, the investor, actually purchasing a parcel of land, holding the deed, and being responsible for everything that comes with it. This could mean farming it yourself, or more commonly for an investor, leasing it out to an experienced farmer who pays you rent. This path offers the most control, but also requires the most capital and hands-on management. For most people, especially those new to investing, the world of indirect ownership is where the real opportunity lies. This is where you can invest in farmland without ever setting foot on a farm. One of the most popular methods is through farmland real estate investment trusts, or REITs. A REIT is a company that owns, operates, or finances income-producing real estate. In this case, instead of office buildings or shopping malls, the company owns a portfolio of diverse farms. By buying a share of a farmland REIT on the stock market, you become a part owner of all the land in that portfolio. It's as easy as buying a stock, offering instant diversification and liquidity, making it incredibly accessible for beginners. Then there's the even more modern approach: crowdfunding platforms. These are online platforms that connect investors directly with specific farming opportunities. A company might identify a 100-acre almond orchard in California that's up for sale. Instead of one person needing to come up with the full purchase price, the platform allows hundreds of investors to pool their money and buy fractional shares of the property. You could potentially invest as little as a few $1,000s to own a small piece of that specific orchard. This model gives you more direct exposure to individual properties than a REIT, allowing you to pick and choose the farms you want to invest in, all from the comfort of your couch. These different avenues, direct ownership, REITs, and crowdfunding, each come with their own set of pros, cons, risks, and rewards. There's no single best way to invest. The right choice for you will depend on your financial goals, your risk tolerance, and how involved you want to be. In the following sections, we're going to dive deep into each of these methods. We'll explore the nitty-gritty details, look at real-world examples, and give you the clear, straightforward information you need to make an informed decision. By the end, you'll have a complete roadmap for how to make big returns with farmland, even if you're starting with zero experience. Let's get started. When we evaluate an investment, we're really asking one simple question: how does this make me money? With stocks, you may achieve increased stock prices and/or dividends. With rental property, you may get property value increases and monthly rent you collect. Farmland works similarly. Two distinct, powerful streams: land appreciation and cash yield. First engine, land value appreciation. Like a house in a desirable neighborhood, farmland value tends to rise over time. It's driven by fundamentals: a growing global population needing more food, and a finite supply of land. This steady long-term appreciation is the bedrock of farmland returns. Second engine, cash yield, income from the land. For many investors, that's rent, leasing to a professional farmer. Lease payments create consistent, predictable cash flow. Lease types include fixed annual payment or percentage of crop revenue. Let's talk about risk. Every investment has it. One of the biggest risks is volatility. Wild, unpredictable market swings. Those swings can wipe out huge chunks of your portfolio in days. We all remember the dot-com bubble, the 2008 financial crisis, the market panic in early 2020. During these times, the stock market can feel like a ship caught in a hurricane. Now, farmland truly shines as a portfolio diversifier. Farmland has low correlation to traditional assets. That means farmland performance doesn't usually move with stocks. When Wall Street melts down, farmland can stay stable or keep climbing. That lack of correlation is incredibly valuable for a resilient portfolio. Think of farmland as a heavy anchor for your investment ship. While other assets are tossed by market sentiment and geopolitics, farmland helps keep things steady. A cornfield's value isn't tied to a tech company's quarterly earnings or a Fed rate decision. It's tied to the price of corn, the productivity of the soil, the global demand for food. That creates a powerful buffer for your wealth during market turmoil. This stability is backed by decades of data. Look at farmland during major downturns over the past 50 years, a consistent pattern of resilience. While stocks plunged, farmland often stayed positive. People still need to eat in recessions and booms alike. Food demand is inelastic. It doesn't drop much when incomes fall. That constant demand underpins land value and creates a price floor many assets lack. It's a defensive play with a strong offensive track record. Diversification is a necessity for long-term wealth. Don't put all your eggs in one basket. Adding farmland to a stocks and bonds portfolio spreads risk across different baskets. It smooths returns and reduces downturn impact. Farmland is that stable, reliable anchor, letting you sleep better knowing part of your wealth is grounded in a real, enduring asset. We mentioned this briefly before, but, it's so important that it deserves its own section. Let's really dig into why farmland is considered one of the best hedges against inflation available. Inflation is the silent thief that erodes the value of your money. $1 today buys you less than it did last year, and it will buy even less next year. If your investments aren't growing at a rate that's higher than inflation, you are effectively losing money. Your net worth might be going up, but your purchasing power, what you can actually do with that money, is going down. This is one of the biggest long-term risks to any financial plan, and finding assets that can protect you from it is crucial. Farmland has historically been a superstar in this department. When inflation rises, the prices of consumer goods increase. This includes the price of food, bread, cereal, fruits, vegetables, meat, you name it. Since all of this food originates from farms, higher food prices translate directly into higher revenues for farmers. More revenue means the land is more profitable, which in turn makes the land itself more valuable. At the same time, the rent a landowner can charge a farmer tenant also tends to increase in line with the rising profitability of the farm. So, during an inflationary period, both of the return streams from farmland, land appreciation and cash yields, tend to go up. Your asset is not only preserving its value but is actively benefiting from the very economic force that's devaluing cash. Let's compare this to other assets. Cash in a savings account is a guaranteed loser. Bonds, especially long-term bonds, also get hit hard. Even the stock market can be a mixed bag. Farmland, however, has a direct positive correlation with inflation. Historical data shows that in years with high inflation, farmland returns have often been exceptionally strong, providing a powerful shield for your portfolio. This inflationary hedge is becoming more important than ever. After years of relatively low inflation, we've recently seen how quickly it can spike, reminding everyone of its wealth-destroying power. As governments around the world continue to engage in massive fiscal and monetary stimulus, many experts believe that higher inflation could be a persistent feature of the economic landscape for years to come. In this environment, owning real productive assets that are linked to essential goods is a sound strategy. Investing in farmland is a proactive way to position your portfolio not just to survive, but to thrive in an inflationary world. It's an investment in the ever-present, inflation-linked necessity of human sustenance. We've covered a ton of ground today. We've journeyed from the basics of why farmland is such a powerful and stable asset, but right now, all of this is just information. Knowledge is powerful, but it's only the first step. The next step, turning that knowledge into action, is where real wealth is built. It's easy to get excited and then just file it away. You might think, I'll look into it later, but later often becomes never. The difference between people who successfully build wealth-generating portfolios and those who don't is often just a simple willingness to take that next small step. So, what is that next step? It's simple. Start your research. Open a new tab in your browser right now. If the idea of REITs appealed to you for their simplicity, start looking up the publicly traded farmland REITs. Read their investor presentations, look at their property maps, and check out their dividend history. If the crowdfunding model caught your eye, go to the websites of platforms like AcreTrader or Farm Together. Sign up for their newsletters, browse their past deals, and see what kind of information they provide. This initial exploration costs you nothing. It's about moving from a passive reader to an active learner. It's about getting familiar with the real-world tools that can make this investment a reality for you. By taking this step, you are bridging the gap between theory and practice. You are beginning the due diligence process not on a specific property, but on the investment strategy itself. You have the map in your hands. Now is the time to take your first step onto the path and begin exploring the territory for yourself. Remember, investing in farmland is a long-term strategy. It's not about chasing quick profits. It's about steadily growing wealth over years and decades. Now, a clear and unambiguous disclaimer. The information here is for educational and informational purposes only. It is a broad overview and starting point for your own research. This is not financial advice. I am not your financial advisor, and I am not licensed to provide investment advice. Investing is complex, and everyone's financial situation is unique. These strategies involve risk, including potential loss of principal. The value of investments can go down as well as up. Past performance is not indicative of future results. There are no guarantees in investing, including with farmland. Before making decisions, conduct thorough due diligence and consult qualified, licensed professionals. Speak with a financial advisor about your full financial picture, goals, and risk tolerance. Talk to a tax professional about tax implications. Talk to a legal professional for direct ownership or partnership questions. Do not rely on a single source of information. Take this knowledge, ask smarter questions, and build a team of professionals to help you make the best possible decisions for your financial future. Good luck, and happy investing.